Welcome back to the Exchange Live. My name is Paul Hill, and by popular demand, I am absolutely delighted to be able to speak to legendary UK small cap investor Paul Scott of Stockopedia. So welcome, Paul.
Hello, Paul, and hello, everyone watching.
No, it's great to have you on the show, and we've got lots of sort of cross currents hitting the markets at the moment. Obviously, on the downside, we've had quite a few profit warnings. We've got two wars going off, one in the Middle East and in the Ukraine. Plus, we've got the overhang of the UK budget and the US presidential elections. But on the other, we do have a seem to have tamed inflation. Interest rates are coming down. Real incomes are rising now, and UK valuations are still pretty low. So, but before we sort of like run through your view overall of the markets, I don't suppose you could just quickly remind the audience what kind of stocks you look for, what kind of investor you are.
Sure. Yeah, that's a very nice summary, actually, of the macro picture, Paul. I agree with all of that. Yeah, I turn over lots of stones, so I focus mainly on smaller mid caps. I try to look at pretty much everything other than certain specialist sectors like natural resources or biotechs, but largely everything else, normal trading companies. I try and look at everything and just find stuff where I see positive risk reward. I like strong balance sheets. I like decent dividend yields. Growth at reasonable price is probably my main focus.
Yeah, no, I love that those principles. But I found it this year surprisingly quite tough. It's been a bit of a grind, actually. I had a really bad start to the year. I've sort of like came a bit back in the summer, but it's dropped off again just recently on some of the news. How's your strategy been going? So I know you've done pretty well this year, haven't you?
Yeah, both Graham, my co-writer at Stockopedia, and myself, we put out these top 20 in my case and top 10 in his case of just share ideas for each year. And I mean, they've done remarkably well this year as well as last year, actually. So we've had 2 good years. Although I'm well off the top. My top 20 is currently up. I mean, it's still up 28% year to date, which I mean is phenomenal, isn't it? Really, it was up 37%.
You're getting greedy there, Paul. Only up 20. That's more than Nasdaq, that is.
Yeah, I know it has done very, very well. We've hit 3 particular big winners that were all up over 100% within that top 20. Graham's slightly behind me; he's up 26%. So we're having a very good year, but we've given back a fair bit in the last month or two. Yeah, we've been hit by a couple of profit warnings, so it's not been completely plain sailing, but it never is it? And I think the market's very, very unsettled at the moment over the 2 main risks, I think, for the small caps, because the main indices are doing fine, FTSE 100 and mid caps. But I think this AIM in particular, there seems to be a widespread fear now that the IHT relief for AIM shares held over 2 years could be under threat. I mean, we hear this every year, don't we? But I think, I mean, to my mind, people are going to hate me for saying this, but I cannot see any logical reason why AIM shares should be exempt from inheritance tax in the first place. So I think it's a totally unjustified tax dodge. And, you know, a tax-hungry chancellor may well go for that, which could cause chaos. There was a note from Peel Hunt, I think, out today or yesterday, saying you could see, you know, 20, 30% drops in AIM stocks if and when these IHT relief funds, which I think is several billion, you know, if they just start pulling out, getting client redemptions. So yeah, I'm really worried about that, actually. That's the biggest risk.
I think yeah, I look at it as a slightly broader picture because the IHT funds, they give vital capital to fledgling companies, both private and to the stocks on AIM. And if you withdrew that AIM relief, you know, the IHT relief from it, then as Peel Hunt points out, you'd get a big exodus of money, which would just go straight into large cap trackers. So the reason for doing it, the reason for the tax so-called dodge in inverted commas, is to create jobs, to create growth, and to improve the UK's, you know, sort of like longer term picture. And also, you know, when it comes to sort of like tax raising, they'll get more money from the winners. And also you've got to look at it through the lens that overall, the reason why, you know, AIM has been given the sort of the tax benefits is that actually the returns on AIM overall have been poor. So it's actually, you know, if you actually look at it, it's been negative for a long period. And that, you know, that's one of the reasons why, you know, a lot of them get the CGT, you know, benefits as well.
Well, I think that's a very rose-tinted view, Paul. I think it's just a blatant tax dodge. The inheritance
Okay.
thing. I think you can justify maybe making it exempt from capital gains tax or something like that. But just being able to park your assets into AIM shares and then suddenly you don't pay inheritance tax when you die, I think that's crazy. And basically the way I look at it is I don't think it's really worked at attracting money into AIM, because look at how bombed out the valuations are. Apart from it's sucked money into certain specific shares, which all the IHT boys focus on, quite a narrow selection, which arguably are overpriced. So I don't know. Look, there's merit in probably bits of what we both say, isn't there?
Yeah. No, I think you're probably right. Yeah, I mean, there are a lot of IHT specific funds, because I mean, Judith McKenzie runs them, Paul Jordan at Amati, lots of them people,
There's
but
quite a few.
houses
Charles
run them.
Stanley, Charles Stanley's quite a
So,
big one. It's several billion, I think, isn't it? So, but I think those funds will want to keep going, wouldn't they? If the AIM relief is the IHT relief is cancelled, they'll be onto their clients saying, look, well, we've actually got a good track record of stock picking, so leave the money with us. And it's unfortunate you won't get IHT relief, or may not. So they won't necessarily all be immediate and forced sellers, will they?
I think that's a rose tinted glasses.
Well,
I think they'll
be
dump
trying
them
to.
straight into ETFs. Anyway,
They want to keep their jobs, don't they? So they'll try to retain the client's money, I'm sure.
Yeah. Anyway,
it's a what
you're
if.
right.
It's a what if. We don't know yet, do we?
Well, let's get bogged down into what ifs in the tax. So overall, then, what's your sort of view for small caps going forward? Just putting the sort of like the potential bombshells from the budget, because obviously we've had a big sell-off in AIM. People have front run it, expecting to get some bad news. But if we don't get that, it could be a bit of a buying opportunity.
I agree. Yeah, I think we're hopefully set up for a really nice autumn rally. There's you're right. There have been a lot of profit warnings recently, but most companies are reporting in line, as they always do, and you've got some very nice opportunities in AIM in particular. I think very selectively. I mean, most of it is absolute trash, isn't it? I mean, I do, reporting on these companies day in, day out. You do look at some of these things and think, why on earth were they listed? But having said that, you've got 200 or 300 really nice, decent businesses, I think, some of which just look much too cheap, I think. And those are the sort of things I've flagged that we can talk through today. As usual, I've looked at the ideas that have impressed me most in the last month or two. So
okay, well, I'm going to give you. If anybody wants to ask Paul a question, please put them into the chat bot, and I'll read them out. Now, unfortunately, Paul, I've got the toughest one first. It's from the TJ009. He's basically asking, what is your favourite stock at the moment?
Oh gosh, well, my largest.
Exactly, I knew that was going to be a tough one.
Yeah, I've got to say that Plexus Holdings, but we've not had any news from the company literally for over 6 months. Yeah. It's just a total news blackout. So I don't know what's going to happen on that. Probably a second one.
Just on Plexus before we move off on Plexus. I know you say it's still your biggest. What's the background? It's quite strange that in terms they have gone radio silent, because they had a series or a flurry of announcements last year. And they would have had to have announced if they were missing expectations for, I think it's September. So it sounds as though they're actually sorry, it's the junior end, is it? Okay, So it sounds as though they've met that, but there's no expectations for 2025, and I guess that's the sort of the unknown at the moment. Why they haven't actually put something out there.
Yeah. Oh, it's hopeless, the communications, and I've been moaning to the management about it for months now. But you see, they did have a changeover of the old guard. I mean, was the former CEO was the founder of the company, and I think he's mid-70s. And he's finally handed over the reins to internal candidates who are sort of getting their feet under the table, I think. So we should, we'll definitely get news pretty soon of how the company's performing. And as you say, they would have had to have announced if they were missing forecasts. There's no reason to believe that they would be. So I'm just waiting. My view hasn't changed on it, because the fundamentals haven't changed. So we'll just wait and see. The thing with it is, though, I want to be in it, because you can't buy in any decent size if it puts out good news. So I would rather take a bit of and I think it's fine for cash, because it raised $5.4 million in a licensing deal at the end of last year. So I don't believe it needs any fresh funding for some time to come. And I just think risk reward on it. This is world-class technology that's proven that's been in use for decades. I just see asymmetric risk reward. If they do, I'd say there's a 20 to 30% chance of blockbuster upside, in which case, I've got a potentially major multi-bagger on my hand, because it's major multi-bagged in the past. Remember, it was worth 300 million back in 2014 or 2015, and the share count is hardly changed. So that we've already seen what upside is possible on it, and legislation's come in America to enforce stopping these wellhead leaks, the leak of methane, which plays right into what Plexus does. So I think it's a really exciting opportunity, but obviously I don't know any more than anyone else. We've had this news blackout. I've engaged with management in terms of saying, I want to talk to you, and they've said, well, we're in a closed period, we'd love to talk to you, but we have to wait till the accounts are out. So I think they want to engage with investors. So I'm not sort of slagging them off publicly because I think we've just got to wait. It's just like, and the investor comms is not up to scratch. I've made that clear to them, but I want to try and positively engage and maybe help them by saying to them, look, this is what investors need, updates I think at least every 3 months, even if it's just to say we're trading in line. So I'm hoping that all that side of things should gradually improve.
Well, we're in the same boat, actually, because sometimes you've got to, you raise a really good point. Sometimes you've just got to take the pain of sort of, companies having to go silent, whether it's blackout periods. Because my largest position, 6 months for no news is actually nothing compared to me, because I've got my largest position is Equals, and they've been in they've been in an 11-month strategic review where we haven't done anything coming out from any brokers at all. So 6 months is pretty easy for me to a certain extent.
It is actually, it is, isn't it? Yeah. You've been totally in limbo, haven't you? There was another shut up deadline extension today, I think, wasn't there, or yesterday?
Yeah. I mean, just on Equals, and I know people will be asking me about it, but the one thing which wasn't in there was the condition for financing. So that now seems to have dropped away. And my instinct is the consortium they're gonna put a figure on the table. I mean, hey, I've been saying this for 9-10 months. But I think they're going to put a figure on the table. The doubt that the market has is it going to be accepted by the institution? Because I've interviewed quite a few fund managers who are not exactly jumping up and down with glee because of the 135 on it. So I think that's the unknown. That's why the shares only trade at 112, 113, 114 compared to the indicative sort of like bid of 135. But anyway, we'll wait and see. But it looks as though the financing, if I've looked at it right, it looks as though the financing conditions are away, and it's all a matter of them putting a number on the table and then agreeing with the shareholders to see whether they're going to accept it or not. But hey, it's out of my hands. You just got to sit there. It's like you just got, sometimes if you put a big position on, then you just got to accept that there's no news, and that's the way it is, really.
Yeah, well, good luck with it. I hope it works out for you. I don't have a strong view either way. It's not a sector that I would invest in. I don't like this sort of race to the bottom on fees, and there's questions over their biggest client as well, isn't there? And so it's not for me, that sector. But I hope you make a ton of money on it. That's the important.
Well, I don't know about that. Well, let's.
We have already.
Not this year, I haven't. Anyway, okay, let's move to a really good stock that has done well for you, Beeks Financial, which was basically it does service solutions for capital markets at sort of high frequency trading. It puts sort of servers into data centers next to exchanges to historically help fund managers and traders to get better execution, but actually has won some flagship deals with big exchanges to help them process those deals. The Joburg one, where they've basically extended it, and they've seems to have won one with Nasdaq, and let's look at them processing a third one. So what's your latest on Beeks? I know you've been talking positively a couple of years, but the shares have just gone to the moon, haven't they?
Well, they have, but they're pulling back strongly at the moment. It's very strange. I think this is one of the shares where we're seeing really erratic price movements that I suspect is strongly probably correlated very closely with people doing strange things because of tax concerns, maybe clumsy sellers. If you've got, a multi-million pound AIM portfolio and people just start clumsily selling those because they don't want to get, so that I think is what's going on here, but I don't know. I mean, it dropped 16p this morning, so I actually scraped up a bit of loose change and bought a few more. So I think it's quite an interesting, very volatile share. It's reporting, I believe, next week. I think 7th of results next week, and I think there's a webinar on Monday. So I'm very hopeful on that because, as you say, the Nasdaq contract could be an absolute monster, and it's not in the forecasts. Yeah. So we could see on Monday a serious increase in broker forecasts. I hope, but let's see.
I mean, how do they win the Nasdaq contract? I mean, that's just enormous, isn't it? I mean, they must have something really unique.
They must, because I mean, I look at it and think, well, cloud computing, surely any reasonably competent IT outfit could put servers into the basement and connect it all up. But it's obvious that Beeks has got something a lot more specialist and resilient than that, and they have to go through a very extensive regulatory approvals, and it takes years for them to build these relationships with the exchange and to win their confidence, because it's mission critical kit. I'm not an IC specialist, so every time I speak to Gordon MacArthur, I did an interview with him about a year ago that was well received by the investor community, so I'm hoping to do another one with him shortly. I always get the feeling after speaking to Gordon that I understand what Beeks does, but usually by about 2 weeks after the conversation, I realise that I don't really properly understand it at all. So,
well, I think they've clearly got something, because the likes of Microsoft would be all over this to try and win a contract with a flagship business like Nasdaq. I think the opportunities, whilst they have this unique differentiating service, is then to sort of like try and win other big exchanges. So basically even the London Stock Exchange. I don't know. Let's wait and see. Okay, we've got another question.
I was just going to say Nasdaq hasn't officially been announced. We just a number of us found a regulatory document on the internet, which made it clear that it was Beeks Financial, and that was from a very good source. It was an official Nasdaq document, but it hasn't actually been publicly announced. So I think it could be very exciting. So I'm really hoping Monday turns out well, but we don't know.
Yeah. I wish I'd had that tip from you. I should have jumped in when it was a quid, but hey ho, such is life. There's lots of good quality stocks we miss. Got a question coming in from Paul L. Crikey, we've gotten 3 Pauls on this one. Paul L, he says, hi gents, any thoughts on Gulf Marine Services? Trading's been very strong, but so do you want to give us your latest thoughts on this one? Because it basically does, just for other investors, large big platforms, oil and gas offshore, to help sort of with accommodation and support services, and I think they're big rigs, but the rates have been going up. Give us your thoughts on how you're seeing this one play out.
Yeah, I mean, the fundamentals of the company are fantastic. It's a deleveraging story. So as you say, they're large self-propelled boats, but they look like oil rigs. They sort of have these 4 legs and they jack up. And they're hired out on daily rates of about, sorry, I always hiccup when I'm doing podcasts. I don't know why, it just happens. So they're doing these, they're hiring them out at about $35,000 a day, I think, on quite long-term contracts with great visibility, and it is generating fantastic cash flows. So and which is enabling it to repay its debt extremely fast. And it was almost insolvent 3-4 years ago. Well, now it's just throwing off. It's refinanced. So the fundamentals of the business are fantastic. However, I think we have got indigestion on the shareholder register because the largest shareholder, CFOX, did a discounted secondary placing. I think that was at 17p when the shares were 20p. And then what they've done subsequently, CFOX, which operates in the same sort of space, I believe, a private company, it's distributed its Gulf Marine Services shares in specie to CFOX's own shareholders. So it's kind of just broken up its block shareholding and given it to all its. So some of those holders probably don't want the shares and are probably selling them. So this is, I think, very much like we had with Card Factory, where you had a big persistent seller in the market. It just crushes the share price and keeps it low. The other thing, of course, the oil price has come down a lot lately. So that is weighing on anything oil related, shares wise, isn't it?
How dependent is the company on the crude price? What sort of like sensitivity? Because it's the crude price has come down a lot, obviously from the highs of over £100 about 18 months ago. But actually, trading seems to be still strong. Is it because it's deep water in or water in sort of the Middle East, which is that they're looking to sort of explore?
Yes, I think they've got 9 or 10 rigs in the Middle East and only one in Europe. So yes, Middle East risk, I think, is obviously probably worrying some investors, given the dreadful escalation of the Arab-Israeli conflict. I think they're based in UAE, which doesn't tend to get involved in wars, as far as I know. The only question mark I'd like to find out about GMS, and I don't know the answer to this, is what are the contractual terms? Because the visibility, the forward order book is 2, 3, 4 years committed, but can the customers cancel? That's the thing we need to find out. So if any readers know, let us know, because that could obviously be a major risk, couldn't it? If they suddenly announce, oh, the 5-year contract we've got with blah, blah, blah has just been cancelled. So
I imagine the answer to that is yes, but they have to pay a penalty. They lose their deposit or something like that.
I'd just be completely guessing, so I don't know on that. But apart from that, I think it looks lovely. So, I mean, I've only got a tiny holding in it personally because, excuse me, I wanted to wait for the CFOX position to fully unwind. So I'm basically just waiting and watching it get cheaper and cheaper. And at some point, I'll pounce and go back in a reasonable, probably put 3 or 4 or 5% of my portfolio in it. But I'm not there at the moment, and I haven't got any spare cash anyway. So,
yeah. You see, and I know when we chatted about it first off, it was on about sort of 4 to 5 times leverage, debt to EBITDA. Now it's just down about 2.5. It must be a cash generating monster, this thing.
Oh, it is. It is. I mean, it's just purely, all you need to do is look at the cash flows, because there's hardly any capex required. The operating cash flows are gigantic, and it's got quite a new fleet. The fleet is, I think, off the top of my head, 13, 14 years old, which apparently is relatively new in this area. The last 40, 50 years or whatever. The danger is that there are if a lot more rigs are built by competitors, it seems to go from feast to famine with the availability of these type of boats. But even if they just have 2 or 3 years bonanza, it's going to basically mean they can clear pretty much all the debt. So I think it looks very, very interesting. But sorry to anyone who's nursing a loss on this one. I can't control what the short-term share price does.
It looks pretty good. I think you've done pretty well, mate. You can give yourself a pat on the back. Now we've got another question coming in from the TJ09 again. He's basically asked about Card Factory, which you just briefly mentioned, because they had an overhang. I was just looking at the share price. I was just putting it on the chart. We'll throw it up in a moment. What happened to the stock over the last month? It seems to have just dropped off a cliff.
It has very much so. This was one of the things we had on our list to cover anyway, I think, wasn't it? I think it's coming into buying range for me personally. So again, I'm probably going to take a starter size position in this myself at some point. I'm just waiting for it to stop falling. The problem, you can see that it dropped. I think it peaked at about £1.45, didn't it? In the run up to the H1 results, which have just come out. I did write a fairly detailed thing on them on Stockopedia on results day, and basically they've said they're trading in line with full year expectations. However, the H1 profit numbers were well down on prior year, but that's the softer half, and they gave quite detailed reasons for why they think H2 will be much, much better. But I think a lot of us looked at the forecast and said it looks a bit of a stretch to achieve, I think it's 13p, the full year forecasts. So it's only on a P of about 7 or 8 now. Even if you take a bit off the forecast because it might miss. So I think it's looking very attractive again now, actually.
What is its sort of USP? Because it does basically, it's the number one sort of gift card and greetings and celebrations and all this sort of provider in the UK. What's the sort of the USP in this market?
Well, it's very high margin because they're vertically integrated. So it manufactures its order. It does the whole thing. It doesn't just buy them from a wholesaler. It organizes full. So very, very high gross margins. And they sell at low value prices. I've got a drawer stuffed full of Card Factory greetings cards. Whenever they bring out the 10 for £1 cards range, I stock
you can't
up.
resist it.
Yeah, so and I mean it must be around about 1,000 stores. I think they're everywhere, aren't they, in the UK? Last man standing as well. There's not much competition, and apparently they do very well selling helium in balloons.
Oh, see.
yeah. So I think it's a good business. It's dug itself out of a deep problem where it was heavily over indebted. Obviously, pandemic, it looked like it might even go bust or have to do a big fundraise, but it didn't. It got through. The bank were cooperative, and it's really traded its way out in a very, very impressive way, I think. So I think it's good business, and I think around a quid a share. Personally, I see that as a pretty attractive valuation.
Okay, well, let's move to the sectors. We've got the software. Let's go to Intercede, which basically does two-factor authentication and really high encrypted password control for employees, largely to those things like the DoD out in the States. So it's got effectively a customer or a client list you could kill for in the most secure areas. So it's got something. And I remember you again banging the table about this about 3 years ago with a new CEO who's turning it around. And the shares have just absolutely rocketed. So what's your latest on this software firm that really has done very well for you?
Yeah, I mean, this is my third biggest holding currently. Obviously it's I think 4-bagged since last autumn, perhaps. But the news flow has been really stellar from Intercede. It's set up distribution of its software through resellers, and these are big systems integrators, mainly in America. As you say, it's got numerous federal American government clients, which tend to be very sticky. The customers, 20 years plus for their customers once they're installed, with recurring revenues. And because it's now got the sales channels all set up right with these big systems integrators, because the product never breaks, it's just totally reliable. They've said to me in the past that they hardly get any support calls because it never goes wrong. Really, really specialized team of people who are all very long serving. The staff are. I even was invited onto a staff webinar, amazingly, at Intercede, just to do a short 10-minute spiel of how a private investor sees the company. I wasn't allowed to listen to all their private stuff, but I thought that was nice as well. So I really, really like the company. It's very difficult to value at the moment. I think it's on a forward PE of about 50. So on conventional metrics, it looks very expensive. But I think when a company is in a sweet spot like this, you throw PE ratios out the window because they're getting just this momentum of almost 100% gross margin contract wins. The numbers could go absolutely through the roof and they're putting out contract win and renewal RNSs about once a week at the moment. But they keep using this phrase, underpin existing forecasts. Well, I think they must be building up to a ahead of expectations update because there've been so many contract wins, and that as well is reporting next week, 8th of October. So we'll keep our fingers and toes crossed there.
Yeah. What sort of percentage of the revenues, if are recurring SaaS compared to sort of perpetual license? Do you know that at all?
I don't know. I'm not going to make anything up. I don't know, Paul. I'm not off the top of my head. I've probably covered that in my previous reports, but yeah. Sorry.
Yeah, sure. That's no problem at all. No, I was just wondering because okay, good. Well, let's stay in the similar sort of sector into sort of like security. We've got Spectra Systems, US company that has just won some really big contracts in terms of it does sort of like materials and sort of technology that helps secure currency or paper, whether it's polymers, etc. And it's got sensor technology into sort of the printed sort of like currency area. Seems to have done some really good deals. What's your sort of your your latest on this one. It seems to be doing again very well for you.
Yeah, it is. Well, it's done moderately well. It's got a very good long-term share price appreciation. Something seemed to click in about 2017 or thereabouts, where the shares began a really lovely uptrend that's continued to this day. It seems to be almost a one-man band. It's only got one executive director, who Nabil, I think, who. Yeah. It's obviously one of these tiny companies with some seriously clever people in it who just keep coming up with these niches. It's got about 4 different product lines, which you mentioned. I think banknote cleaning is what their original thing. You might think, what a bizarre activity, in our banknotes going out. The answer is no, they're not. They're still very, very important around the world. And it's almost, part of the business is almost like a mini De La Rue. And they've made this interesting, very interesting acquisition of an Anglo-French business. I can't remember the name of it off the top of my head, that prints postage stamps for 180 countries around the world. But it also does high security. The thing is, these things are not just, plain paper. They've got high security methods in there. They're constantly having to outfox the counterfeiters, and it also even has some gaming software authentication wing to it. It's a really, really interesting little company, Spectra is, and it's got a great track record. It pays as well, generous dividends. It's paying about 4% dividend yield.
Yeah.
And the forecasts are that profits are going to double in 2025 because this very large contract with a central bank to do some sort of sensors is very high margin work. And it's not a one-off contract. It's the 3rd time they've won a major sensors order from this particular central bank client. And it's got close relationships with major central banks all over the world. So I think it's a really special little company, Spectra. That's why I hold it personally.
Yeah, I think that that big, so the sensor, it's got the sensor contract's got 2 elements to it. It's got the capex which goes in, and then it's got the whole bunch of services off the back of it, hasn't it? So and that goes for another 10 years or so. So I'm with you. Yeah. I think it's got a great recurring aftermarket revenue stream generated just from that central bank contract.
Yeah, and it just churns out profit each year. The profits go up each year. It's cash generative, paying out the divvies. The most recent accounts I looked at a couple of days ago did show a quite heavy absorption of cash into working capital, but I don't think that's a problem at all. Some people wrongly assume that negative cash flow into working capital is cash burn. Of course, it's not. It's just temporarily parking some cash, because it's building up the inventories for the large sensors contract. So that should, and the company actually explicitly said that will unwind next year in 2025. So it should throw off tons of cash next year. And I think that's a great catalyst for this share to re-rate, because the forward PE is only about 8.
Yeah.
I just think it's the wrong price, but we'll see.
Yeah, no, it looks very good. Okay, well, let's switch sectors to the consumer and pick your brains how the Mary Sherry at Bournemouth is going with your with your mystery shops. Let's go to JD Witherspoons, because they've obviously benefited from the Euros and probably a bit from the sort of but there was a bit of a wet summer and stuff like that. What's your latest on that, sort of like just the whole consumer, and also JD Witherspoons, the pub chain in the UK?
Yeah, no change really. This is a fairly pedestrian share pick, which I hold personally. It's just I think it's an outstanding business in a very tough sector. I wouldn't generally want to invest in pubs, but JD Witherspoon's got a very distinct advantage. It's something like 40% cheaper than its competitors. Very nice, reasonably priced food for refueling while you're there. Table service, from an app. I think it's a really, really good business. Just the classic pilot high and sell it cheap type of operation. They're always busy. The new one at Waterloo Station I visited in the sidings there. That's a cracking pub. I mean, I got fish and chips, very nicely done fish and chips with a pint of Stella for £10.37 in central London. It's insane.
I know.
They'll be mobbed out there. And yeah, so no, I just think it's a nice, steady accumulated. I think that share should do pretty well. And it's moderate. P's 13, 14, I think, isn't it?
Yeah.
It's
Yeah, I
got
think you're
loads of
right.
freeholds as well, and I think Tim Martin's a legend as well. He's wildly eccentric, so I think, but he's a very, very shrewd, safe pair of hands, I think. So yeah, I think just good. It won't shoot the lights out, this share, but I think we should do well on it over the next few years.
Yeah, the £10.50 is a terrific price, because if I go down my local chippy, it costs me like 14 quid, and that just comes out of a paper. I have to take it home.
Yeah,
That is fabulous. Okay, good. We got a question coming in about, I think it was a company which did a profit warning, unfortunately, today. Wynnstay, or maybe yesterday. I saw it over the headlines. It's about agricultural feed. Yeah, I don't suppose you've got any quick words from there. It's basically a question from our son, or our saint. Any thoughts on that at all? Because we do seem, just broadly, we do seem to be getting quite a lot of profit warnings. I had one today myself, and one yesterday. But what was quite interesting as well, the actual price didn't go down as much as I was expecting, which says to me that we're maybe reaching a bit of a bottom here. But anyway, let's start off with Wynnstay and how you treat profit warnings at the moment.
Yes, that's right. You're right. We're getting about 4 or 5 profit warnings a week, looking at my color-coded spreadsheet here, which is a lot more than we were getting earlier on in the year. There doesn't seem to be any particular pattern to them either, although sometimes it's interesting, you can find a bit of nervousness in the previous outlook statement, so I think sometimes these things, and that was the case with Wynnstay, it had previously said that it was a challenging year, so that can be a deferred profit warning. I spent the whole morning on Wynnstay today, absolute nightmare. I was writing a section on it for my usual Stockopedia report, and all the numbers just didn't make sense, and I couldn't find broker notes. And in the end, I realized, what I'd done? I was comparing the forecasts for NWF with the actual results for Wynnstay. So I was mixing and matching figures from 2 completely different companies.
I'm not surprised. God. That was a bit of a nightmare.
Oh, well, I had to go and have a lie down. I said to Graham, I'm going to have a nap, delete the whole section, start again. So I just published it actually about an hour ago. So yeah, the shares have only dropped 6% to £3 from Wynnstay, WYNN. It's an agricultural feeds type distribution business, very low margin, but it's got an unbroken 20-year history of increasing its dividends. So the main attraction to it is that you get now nearly 6% dividend yields, and that is forecast by Shore Capital to be maintained, only just covered by earnings. The earnings forecast from Shore dropped 34%, and I must thank Shore Capital and the other brokers that do publish these notes for private investors to see, usually through Research Tree. It's absolutely brilliant. It's incredibly helpful, so thank you to them. So anyway, forecast for October 24 year end earnings, the forecast earnings have been dropped by 34%. The share price has only fallen by 6%. So, and I think it's mainly the dividend that's held the price up, and the balance sheet. It's now trading at a 40% discount to its own net tangible asset value. So I went through all of that in my review today. It's got some freehold property there. You could argue that, okay, it's got all this working capital, including net cash, that it's generating a lousy return on. So you could argue, well, the assets don't matter if they're not really producing much productive output, which is a fair point, isn't it? But I think it could attract maybe a financial buyer at some point who might say, look, let's shake these things up, let's squeeze the working capital, and you could extract a lot of cash out of this, I think, potentially. So I can understand why long-term holders will just ignore the profit warning and carry on holding.
Yeah, it's not a lifestyle business, this one, at all, is it? These sort of, they don't really seem to engage much with the retail investor community, or even the
don't know. I mean, I would say not, because given that it's paying these generous divvies and has done for over 20 years and raised talk is cheap, but getting a 6% dividend yield that's risen every year for 20 years, you can't argue with that, can you? I mean, that's good for shareholders, I'd say. But although the share price has gone nowhere in 20 years, but if you were to add on I wish we could have share prices that showed the dividends as well added on, to show the total return, would probably be quite good.
Yeah. Okay, good. So let's move back.
Moderately positive, amber green is how I describe it for Wynnstay. Yeah.
Yeah, okay, good. Okay, well let's go back to the consumer. We've got On the Beach. Given you've just come back from Gozo, you've probably been testing the services out there. I'm not sure, but anyway, they seem to be surprisingly doing very well against the bigger competitors like
Yes.
TUI and Thomas Cook, knocking the ball out of the park. Strong first half, strong future bookings.
Yes, that's right.
What's the current investment? Yeah, what's the current investment thesis on this one?
Just that it's cheap, just that it's trading well, and the PE is somewhere between 8 and 9. Graham looked at it, so I'm not fully up to speed with all the detail, but I did have a quick look myself, and I thought, yeah, that looks good. And actually, there was an interesting catalyst that we did pick up on at the time, that the founder, I think it's Simon Cooper, he bought something like 2 or 3 million quid of the shares in the open market at about 95p. And I think you can see that on your chart. It triggered a move up in the shares, and then they put out a great update. So I think when you see a director, particularly a founder director, really opening up the checkbook and spending, hundreds of thousands or even millions on a company share, then you can be pretty sure it's not going to put out a profit warning, can't you? They know the business better than anyone. And, I don't like these 5, 10, 15 grand PR type director buys. If anything, they're almost negative, I think. But somebody spending a couple of million quid on the shares, it shifts risk reward highly in your favor, I think. So that was why we actually caught that big move up, me and some of the readers. But it has drifted quite a long way back down again, but it's just put out a nice trading update. So I think people seem to be prioritizing holidays, don't they? And consumers are now seeing real incomes rising, as you mentioned earlier. So yeah, On the Beach, I think it's good value. Yeah.
Is there any risk that we've been basically through a period of revenge travel? Because we had revenge spending when we were all in lockdown. We then had revenge drinking when we could get down the pub. And now last year in the 2022 revenge travel, all the sort of tourist spots around the world have just been absolutely, slammed out. But you get into a stage where a lot of the big popular areas are banning tourists because there's so many. Yeah. My instinct is that people have just been going holiday mad this last year, and you might find it just the froth just coming off the top because people are sick to death of going through, sort of like an airport or going to a really hot location because, frankly, it's 50 degrees and they've got to stay inside in aircon. I could be wrong. I mean, I don't know what your view is anyway.
I don't really have a strong view on it, Paul, but what you just said all makes a lot of sense to me, anecdotally. Yeah, I mean, maybe we're still seeing some sort of pent-up demand from the fact that people couldn't have proper holidays for several years. So I don't know. Yeah.
Well, it's definitely the pandemic sort of lingered, hasn't it, with effects throughout the economy for ages. But at least the supply chain seems to have sorted out. One which has done well from the reopening is Hollywood Bowl, which is the UK's largest 10-pin bowling business. I know you quite like this one. Again, pretty much only 13.5 times PE. Got lots of cash on the balance sheet. Seems to be doing pretty well, offering good, affordable fun for families down the local alley.
Yeah, I think it's really nice, sort of reasonably priced value stroke growth company. It's self-funding its own expansion. I think we've talked about this one several times before, but I don't really understand why the share price has been soft of late, given that you have got an improving outlook for the consumer. Again, now, is this one fully listed or AIM listed? It's fully listed, so we're probably not getting any AIM IHT selling. But I don't really understand why the price is where it is. I think it's worth more. So yeah, just thought I'd flag it.
Yeah, no, I think it's good stock. Okay, we've got a question coming from Tros. He's basically asking about Somero Enterprises, which does those high accuracy or performance screening machines for big flat floor to help big flat floors in large sort of like warehouses, largely in the States, I think, the online warehouse sheds.
Yeah, I think this one won profits, didn't it? Graham covered that one, the interim results on the, I think, 29th of August. He went to Amber, which is just neutral for our system. H1 results. Yeah, Graham says here he's a bit nervous about it being able to hit full year forecasts. I think they had problems with the customers had problems with supply of concrete, didn't they? Supply chain. And international sales have plummeted. So we're not quite as keen on Somero as we were.
Yeah.
But I have a feeling I looked at it myself again, maybe a little bit earlier than that, and I thought it was quite good. Oh, here we are. Profit warning end of July I looked at. Now, I was a bit more positive than Graham. I was amber green. H1 was very soft, but it still generates a lot of cash, and it's expecting a recovery in H2. So I concluded disappointing, but not a disaster on its profit warning. A strong balance sheet, plenty nice divvies. So I still quite like Somero, but Graham is not quite so keen.
Yeah, you would have thought it would benefit from.
What's your view? Do you know this one, Paul?
Well, I would just say, in terms, it's obviously a cyclical industry, construction and big sheds. There's some secular tailwinds in terms of putting the online, sort of warehouses in. But given America has been supported by a lot of the infrastructure spend, my instinct that it's probably going to do pretty well, actually, because there's so much being built. Because you need pretty flat floors and things like chip factories, not your your silicon chip, these big massive wafer factories. So I think overall, I don't know. I mean, I'm not an expert at construction, but if anywhere in the world is booming in construction or should do well, it's the States, because there's so much.
Well, that's right. I mean, I was looking at the GDP figures the other day, and Indonesia and America are the only two sort of reasonably medium to large economies that are actually growing strongly. I think US GDP is growing about 3%, isn't it? So, which you would imagine, and that is almost Somero's market is almost entirely America, and they had various sort of temporary problems. So I think Somero, I suspect it could come back quite nicely, actually. Although Graham has questioned, my colleague Graham has questioned the competitive landscape, where Somero does make very high margins and seems to have this space to itself. But apparently there are some new competitors maybe trying to muscle in. So don't know.
Yeah, well, it makes good margins, so it's certainly going to attract competition, that's for sure. Okay, we've got another question coming from John McFarlane. He's asking about SAGA, which is the insurer and the cruise line business. I think he says you were keen on it in the past, and whether you had a look at it recently.
Yeah, I went off this one because the recovery after the pandemic was very, very lackluster, and it's had quite a few problems with its insurance division. And the cruise ships are doing well. They're I think operating close to capacity, and obviously the debt is something that unsettles a lot of investors. But it did repay fully one of its two bonds, and most of the debt is just asset funding for the cruise ships, which are owned outright. So it's looking at moving to an asset-light model, so possibly sale and lease back of the ships. I don't know. Would clear most of the debt. And the latest news on SAGA, I think yesterday it said that it was the accounts were going to be late. Rather vague statement about saying that they're exploring strategic options or something to unlock shareholder value, all rather vague. But it did say, actually, it did put a mini trading update in the announcement, which came out very near the market close last night, which is a bit annoying. And it basically said, the guidance is unchanged for H1, and the outlook for the full year is, which I think is January 25, is also in line. I see the shares have reacted quite well today. I think they're up 10 or 11%, but from a fairly low sort of level. And what was the other thing? Oh yes, there was remember that insurance group, Agias, is it? Agias, I don't know how you pronounce it. It's Belgian, isn't it? Big insurance group.
Yes.
It's apparently doing some sort of, I think it called it a proposed partnership with them for SAGA's insurance division. So I don't know what that entails. It did try to sell its insurance underwriting division before. I think it wants to sell that. So it looks quite interesting, actually. SAGA could be worth a fresh look, to use our stock phrase for things we haven't got time to cover in detail.
Yeah. Well, that Belgian insurer, they tried to buy Direct Line, didn't they? About a few months ago or 6 months ago, and they got rejected because it was too low. But it wouldn't surprise if they. I mean, let's be clear. Insurance is if it's just normal sort of travel, car, home insurance, it's a tough industry. That is hyper
It
competitive.
is, isn't it? Yeah, yeah. And the other thing, although with SAGA, I think the main insurance business is just a broker, so it makes 70 or 80 quid per policy sold and doesn't have the actual liabilities connected with it. But obviously the underwriting division does. So I think it would be a better share if they did dispose of the underwriting division. And the other question mark I got over SAGA, whether you need a brand for the over 50s. You know, I think these days, maybe in the olden days, but these days, I think pensioners and people, well, I'm over 50 as well, people are pretty savvy on the internet, you know, and they don't think, oh, I've got to insure my mini metro, I'll have to go to an old people's insurance firm. You know, they'll just put it in Money Supermarket and see what, and go with the cheapest, won't they? So I don't know if there's any real need for SAGA anymore. I don't know. What do you think?
Yeah, I'm with you. I just don't see it, to be honest. But hey, if they can unbundle and release value, then that's probably the best option for long-term shareholders. Okay, one which has done really well for you is Funding Circle, which basically is a P2P lending platform that matches sort of institutional money with businesses who need sort of startup funding, loans, etc. It's gone through a real.
What's the ticker on this one? FCH, isn't it?
FCH, yeah. It's 160.
Sorry, you were saying.
136p at the moment. Done very well of late. Actually, this year it's actually just rocketed. But they've sold their unprofitable US business, and they're going to be profitable in the UK, I think, the back end of this year, and then they're going to really sort of launch into the into next year with double-digit top-line growth, and I think it's 15 to 20% EBIT margin. So they're really onto us a bit of a winner here. What's your sort of like the thesis for this one? Just keep running the winners on this one?
Well, I'm late to the party on this. I only bought it around £1.30, so I'm only 2-3% up. I wish I'd listened. Well, I did. This is the annoying thing. I did listen to people like Richard Crowe, and I think a couple of fund managers that you might have interviewed.
Richard Stavely.
Richard Stavely, yeah, they were all over it earlier this year. And I remember thinking, oh, that sounds interesting. But I didn't get around to looking at it until it had already multi-bagged. But I actually think it's still cheap. Because echoing what you just said, the interesting thing is that the core business is actually very profitable, but they're developing these other, I think, 2 new lines of business which are loss-making but growing very strongly. So it's one of those sum of the parts things, and plus it's got tons of cash on its own balance sheet that it doesn't need, and so it's been doing buybacks. I think this looks really interesting. I think Richard Stavely might have been the chap who was saying, if you value this as a fintech, a fast-growing fintech, which it basically is now, you know, you could get to a much, much higher valuation. And when you strip the cash out, I think that makes up a good chunk of the market cap. I'm thinking maybe a third-ish. That's very rough. And I watched a webinar with the company, which I thought was really impressive. What they basically said is that I think they got something like 2 billion of institutional funding lined up to lend through their platform, because their bespoke credit risk assessment, credit scoring is, I think they said 3 times better. I don't know on what parameter, but 3 times better than using conventional credit scoring. Now that really caught my attention, because I've always thought how clumsy and ineffective conventional credit scoring is. You know, when you look at the default rates on credit cards, for example, are so high. Surely it must be possible to better screen out people who are likely to default. So I think there's a big opportunity in the lending market for, you know, more sophisticated data-driven credit scoring. And Funding Circle, if you believe their claims, we've only got their word for it, seems to have sort of created what's your phrase about a source, a secret source or something? So yeah, I think it looks really, really interesting. But look, I'm not an expert on financials by any means. So people, you know, obviously everyone needs to do their own research on everything, but particularly in this case, I just buy stuff where I think there's something interesting there, and this ticks that box.
I think they lend. I think the institutional money they get, they lend out or they match out to businesses. So it's a business lender
Yes,
using institutional
SMEs, isn't it?
rather than actual, which is a better credit rating than people on who've got credit cards. So
yeah, you're right. Sorry, that was a bad reference. Yeah, you're absolutely right.
but no, I think I'm with you.
Market's very underserved, I think.
Yeah, it is. Yeah, I mean, they could disintermediate the banks, no doubt about it, when they're lending. And I remember when I first looked at this was valued just as a sort of like it was 10 times sales, and it's still recovered a lot, but it's still only 1.4 times sales because it's really now hitting its operating leverage. So yeah, I'm with you. We could look at this. You could say, crikey, I wish I'd bought it at 30p, sort of like 12 months ago. And it's because it's got 135, but actually this could go to 3, 4, 5 quid quite easily, just because it's got that momentum behind it.
Yeah, that's right. The unfortunate thing with this one was it was a really massively overpriced original float, and it's still way below the float price. But you're actually getting a much better business now. That's the interesting thing. And unfortunately, one of my friends who's a shorter asked me to check it out as a favor for him not long after it floated, and I said, yeah, it's an absolute slam dunk short. It's just hopeless, and it's probably going to go bust, because that was how it looked at the time. But I didn't spot the turnaround, I'm afraid.
Well, you can't get every call right there, Paul. You do pretty well.
But I think it's a good example of where, even though it's 4 or 5 back, normally you'd say, oh, I've missed the boat. And we're all guilty of that, I think, sometimes. But when I went through the numbers in September, I think it was, here we are, 5th of September's small cap value report. I was really impressed. That was when it was £1.14. And I thought, okay, it's 3 or 4 bagged, but actually it's still cheap. So, I did buy some, yeah.
Yeah, no, I mean, anecdotal evidence as well. I mean, they've offered me loans on them, it's not me personally, but my business, PMH Capital loans. And they're pretty high rates. I haven't taken them because
are they?
Yeah, they're pretty high rates, and they do a thorough credit check on you. So
what sort of annual percentage are you looking at then for that?
Well, the sort of teaser deal that they gave off was 7%, okay, but actually they said, but then I spoke to the guy and he said it was between 7 and 35.
Bit of a spread there, yeah.
Exactly. I sort of think, can't you narrow that one down? And he says no. Okay, right, fine.
Crazy.
Right.
Yeah.
Okay, let's go to a bank. Actually, let's go to OneSavingsBank, which has been around for quite some time. It gets most of its cash capital from deposits and then lends it out to buy to let, and it's got about a 10% share, I think, of the UK's buy to let market. But I know this one it's more of a traditional sort of like lending institution. But it trades dead cheap. It trades at I think the net tangible assets I worked it out were about £5.70, and the shares are about £3.90. What's your thoughts on this one, the OneSavingsBank? Because I know you quite like it.
I do. I've got a small position in this one as well. I do like it. I never normally invest in banks at all because their balance sheets are just ludicrous, and there's so much black box stuff in there. You don't really know what's going on. And they've got such a tiny wafer thin capital as well. I looked at Barclays and I was pretty scared by the numbers. So I don't touch banks. But OSB, I looked at the numbers and I thought this is so straightforward. It's got about 30 billion in assets, which is the mortgages to buy to let landlords who, of course, don't default. Well, only a tiny number do. And then the liabilities is mainly retail deposits that it's just taken in, and it makes a roughly 2% interest margin, and it's very nice business. So it's the straightforward nature of the business that I like. Absolutely, I think it's got quite a lot of different brands that it trades under. The key feature I like is that I think you're getting about an 8.5% dividend yield. I got a nice a divvy the other day from it, actually, or a few weeks ago. So you're looking at this one for a very large dividend yield. But as some of my readers pointed out, all the banks are cheap and trading, some of them even trading well below net asset value, and you can get big dividends from other banks as well. So the whole sector is quite cheap. But I've chosen this one, OSB, purely for its simplicity. Now, on the downside, it did warn on profits on, I think, 19th of August. And the broker forecasts are almost continuously falling on this. So it does seem to be experiencing some margin squeezing from competitive pressures. But I think when you look at how slow the residential housing market has been, and that quite a few buy-to-let landlords seem to be exiting the market, I think its performance actually is pretty resilient. So yeah, I think that one's worth a look. Mainly for the dividend yield, and it's doing big share buybacks, generates a lot of cash, got a pretty robust balance sheet, and I don't think you have to worry about bad debt risk. That's the main thing, because of course the lending is all secured, isn't it? So secured on properties, and buy-to-let landlords, very rarely default. So yeah, I think OSB is worth a look.
Yeah, no, I mean, I think you're right. A lot of bad news is priced into that share already. So yes, less the buy-to-let market may have some sort of like secular headwinds in terms of greater regulation, and also you've got those holiday homes at coasts which are then getting nailed because council taxes are getting doubled at these holiday hotspots. So yes, there's less people doing that type of stuff. But frankly, a hell of a lot of bad news is in the price, isn't it? So
it is, isn't it? Yeah, and apparently OSBs. Yeah, I read their annual report, and they were saying that the sort of single property type buy-to-let people are generally drifting out of the market, but a lot of OSB's customers are professional buy-to-let landlords who maybe have a portfolio of 10 properties or something, and they buy them now through limited companies. So it looks as if it's corporates, but it's actually not. It's just individuals, but who are buying through a limited company because it's more tax efficient, apparently. So, there's still plenty of activity in the market. And of course, the market's warming up again now, isn't it? So I think maybe any regulatory or tax issues could probably be offset by just a general reawakening of the residential property market. Maybe, I don't know.
Yeah. Anyway, okay, let's move on. We've got another question from another Paul, actually, and he's got a picture of a parrot next to him. So this is Paul the parrot. He's basically asking about, he says, are you still a fan of Volex, which is basically a cables, sort of like, it does sort of like some less sophisticated cables, but actually quite a lot of high margin cabling into things like medical, into data centers, into EVs. The margins have been picking up. It's run by Nat Rothschild,
yeah.
Rothschild, yeah, and he was just asking about what's your latest view on this one, because the shares have just come down a touch just of late.
Yeah, well, this is I like the fundamentals of it, but I just don't understand why the shares can't seem to gain any traction. People keep thinking, oh, it's going to warn profits, it's going to warn on profits, and it just keeps putting out inline updates. So I like the business, I like what Rothschild's done with it, but I should be completely transparent here and say I didn't know it was going to come up in our discussion today. I actually sold mine this morning,
Okay.
but it was only a tiny position, and it was in my SpreadX account. And when I saw, the reason I sold them was because I wanted to prune back my exposure. I didn't want to be geared on a big, on lots of AIM positions, because that Peel Hunt thing that we talked about before really did give me a bit of a fright today. I thought, well, hang on, I've just started using a little bit of gearing in a small SpreadX account. I don't want to blow the damn thing up again like I've done in the past on running into AIM IHT relief being abolished and the whole market plunging by 30%. So I just thought, right, I've made a list of all the positions in SpreadX, and I separated them into main market and AIM. And Volex was what I had 5 companies that were in AIM, and Volex was one of them. And I should disclose, I mean, it was literally, oh God, it was about 1% of my total portfolio. And I just thought I want less exposure to AIM until we know what's in the budget. So that's the specific reason that I got rid of my small position in Volex this morning. And I sold half or a third of some of my other really tiny spread bet positions in AIM shares, because we were discussing this with the readers yesterday and today. I just think, well, I can buy them back, can't I? Might have to pay a little bit more, but I don't want to go into potentially big budget changes with any gearing. I haven't touched any of the positions in my ungeared portfolio. It doesn't really matter to me what happens with IHT, because I'm not planning on checking out anytime soon anyway. So, and, you know, fingers
Okay,
crossed.
well, I've got the second toughest question of the day for you, Paul. Okay,
Cool.
given what's happened in the past, why are you now going back to using your Spreadex account? Given the market can do horrible things at very rare occasions. Because I look at back, you know, I think you and I both left our corporate careers exactly the same time, 2003, and we've both been investing professionally in small caps through over 20 years now. And so we've both got, that's why we've got our hair so short. And we've both been through the great financial crisis, had a bit of a wobble at Brexit, the pandemic. So you get these occasional absolute nightmare times where frankly everything goes down, regardless of big, small, or anything. And so the question is how come you've decided to go back into using the Spreadex account? Because at those worst points, it can be brilliant or give you a lot of problems.
It can. I mean, normally you can see these big problems coming. It's like with the, you know, and you can take some risk off the table. They're normally, it's like with the pandemic. The news on these cruise ships being full up with people who are sick and so on was in January 2020. You know, there was a good 2-month build-up of this, and I actually I trimmed back my gear positions and put on some shorts. So you could see those things coming. And same with the Brexit vote. You know, you knew there was an outside chance of something unexpected happening. So you put a short on, or you to hedge, or you take some risk off the table. So what I've got wrong, the reason I've blown up spread bet accounts in the past is because I let them get too big for a start, and in the good times, and I got complacent, and then thought I could ride out bear markets. Now, so the big learning for me was you just cut the positions and you cut them early. So that's what I'm doing this time. You know, I'm not sure about what's going to happen with this IHT thing, so I've just cut probably about half of my AIM positions. And the other thing is the Spreadex account now is very small. It's you know, it's only 3 or 4% of my total net worth. So that's my plan, is to not let it get big again. I just wanted a little small pot to basically have a bit of fun with as well. To trade a few things. And you see lots, doing what I do with the Stockopedia work, you see lots of opportunities to make maybe a quick 10 or 20%. But because I've just got money locked away in my SIP in small illiquid things mostly, I don't have any available capital to take advantages of those things. So that's really where I'm at with the Spreadex account. It's not going to be, and I've put a whole set of rules in as well, one of which, the main one, I've already broken and ignored, which was which is that if AIM goes below the 200-day moving average, I'll cut all the positions. Well, I've taken a view, it has gone below the 200-day moving average, but I've taken a view that's due to a very specific reason. So, you know, so that's the answer. I'm not going back to the swashbuckling days of having millions of pounds in these accounts. And I mean, at my peak, I had something like 12 million pounds of the gross market positions in a Spreadex account, which was completely crackers. You know, geared up, of course, not anywhere near that much in equity. But it was just an accident waiting to happen. So yeah, what I'm now doing, keep it small. If it gets to, you know, X amount that is more than maybe 10 or 15% of my net worth, I'll just take half the money out. So that's the plan. I think if you have to use gearing, it's best to keep it small.
Yeah, and if you've got to manage discipline, no, I would agree, manage that risk. Okay, we've got a bit of M&A. A few M&A questions coming. We got AJC2. He's asking about Kitwave's acquisition of Creed Catering for 70 mil. I remember looking at this last week and it looked a really good, smart deal actually. But I don't know if you have any thoughts on this one. I mean, basically Kitwave, just for investors, are a wholesaler of food ingredients to sort of like convenience stores and also to restaurants and other food service outlets. And they've bought this one which does more in this food service area, I think.
Yeah, I covered it last on 3rd of September on a trading update. I think Kitwave's quite a good business, established a reasonably good track record. It's doing sort of geographic infill type acquisitions, isn't it? Which makes sense, and also where it can bolt on more product lines onto it's got a van going around anyway, you know, and if you buy some complementary products and so on. I think they said yeah, decent summer trading. That is their peak period because I think of ice creams and soft drinks and so on. So I was previously a bit worried there might be an H2 profit warning. I can't remember anything specific about the latest acquisition, but I'm amber green on it, which means I'm moderately positive. That was when the shares are £3.35. What are they now, Paul? I haven't.
3.45.
Oh, they got up a little bit. Yeah, I think it's quite good. It's not a bad business, but
yeah. Okay, good. We've got also the other one. We've got, which you can say a few words. It would be apparently was today was Musicmagpie getting, which is basically which is electrical recycler. I think largely of sort of like used to be old CDs, but does mobile phone recycling and well, effectively reusing actually more. Takes old phones, refurbishes them, and then sells them out. And it was bought by AO World. But I don't know if you've got any quick thoughts on this one.
Yes, it's a terrible business. It floated at £1.93. And it's agreed a takeover bid today, I think at a whisker over 9 pence. So basically, I've been read on this for a long time in my traffic light system, just saying it's not a viable business. The business model didn't work. The figures were shockingly bad. It was running up bank debt, buying all these second-hand phones and giving them to people who then defaulted after a few months. That was a ludicrous business model. So it never stood a chance. And the alternative to the takeover bid today would have been zero on an insolvency. So I think people who bought this share and were duped by all the rubbish that the company and the brokers talked about its business model, really need to go back to square one and take a course in how to read company accounts, because I mean it was glaringly obvious that the damn thing didn't make any money. It was ridiculous. So yeah, very scathing on even by my standards, very scathing on Musicmagpie. Well, I hope I help people avoid losses on that by flagging up pretty much right from the start, and it was just a hopeless business.
Yeah, well, I remember speaking to remember when it floated, and I spoke to Andy Brough from Schroders, who was one of the anchor investors. Yeah, and I think it's like even if you're a great investor, sometimes you get it wrong, and unfortunately,
and also obviously it would have looked a lot better when it floated, but I think it was one of these opportunistic floats where they passed off the pandemic boom trading as being structural growth, which of course it wasn't. But also, it's easy to be wise after the event, isn't it? I mean, it was selling books and CDs and DVDs and things, and that market is obviously just declining, isn't it? And not very profitable. But this mobile phone thing was utter nonsense. I mean, it was obvious it was a daft idea right from day one. So as you say, we all get some of them wrong, don't we? The key thing, I think, is to do the numbers, recognize that actually, sorry, I keep bashing my microphone. Say, look, the numbers just don't stack up, and ignore what the PR people say about, ignore depreciation charges. You can't. They've spent all this money buying mobile phones, so you have to rapidly depreciate them, so they just bamboozled people with nonsense forecasts and things. So I'm glad to see the back of it. We need a few more hundred rubbish companies to leave AIM, and let's have a smaller but higher quality market and get some decent floats. I was pleased to see, actually, just as an aside, Mpac, I think that's one you've covered before, MPAC, got away quite a chunky placing yesterday at a 4% discount to do quite a big acquisition. That is really encouraging for read across. I think that is proving that actually there is institutional demand there for placings and fundraisings where there's a credible reason to do the placing. So maybe that's a green shoot of a market, and it's done very well since the announcement. The placings at £4, and they are £4.75. That's impressive, isn't it? So it's nice to see an AIM company being able to do a deal, get backing and funding for it without much of a discount. So hopefully we'll see more of those type of things.
Yeah, no, it seems to be they've got a really great, management team who have really driven that business, and I think it was one of those complementary acquisitions that helped it significantly, give it an end-to-end solution, doing high-speed packaging and automation solutions into a factory. And what was noticeable afterwards is all the brokers increased their price targets from roughly around about £5.50 to 8-9 quid. I mean, it wasn't just it wasn't just a couple of pennies. It was actually another 3 or 4 quid. So
I saw that. I mean, the only thing is, I would say I'm a little bit more cautious on so-called transformative acquisitions, because very often, as one of my readers quipped today, very often they're transformative, but not for the reason the company intended. You know, it is quite risky, a small company making an acquisition that was a large percentage of its existing market cap. You know, in fact, so there's quite a bit of risky. You can't just assume this is going to be an amazing transformative deal. If it was, why were the vendors selling? You know, they know the business best. So I like to see 6 or 12 months track record of a big acquisition. Has it actually produced the results that people hope for? But, you know, well done to holders. Shares have gone up. That's all that matters.
Yeah, no, well, and also, you know, getting back to the original sort of like, you know, observation with IHT, a lot, you know, IHT funds would have helped this one get the money that it needs for its acquisition, which may not have been possible over the line, you know. So when we point Rachel Reeves into what she's going to do on the 30th, basically don't shoot the baby or the golden goose that's helping a lot of businesses.
Yeah,
okay.
I mean, I think if they're gonna get rid of IHT relief, do it when the market is buoyant, not when the market's absolutely flat on its back like it is at the moment. So timing is important as well, isn't it?
Yeah, no, it is. Okay, we've got a question from Nigel Batty Symes or Seams. He's asking about Journeo, which he says you quite liked last time, which is basically does transport rail technology, ticketing and digital sort of like boards on at Euston and this sort of stuff. But also does some clever technology for buses, I think, with cameras on the wing mirrors and stuff like this. Bit of a buy and build strategy. What's your sort of your latest on this one, Paul?
Yeah, we've covered this one 6 times this year, and we've been green, I think, every time, which is our top view on it. Yeah, we really like it. Management have transformed it it was originally 21st century technology, it was called, wasn't it? A very small, sleepy sort of Me Too type of CCTV company, but they've made some apparently very good acquisitions that have really that have been genuinely transformative for the numbers. So yeah, we really like it. And this was another company that did a very strange and deep plunge in price. We actually held our nerve when that happened and said, look, we're not turning negative on it because we think it's a really good company. So I'm glad. Oh, actually, the most recent time we looked at it, very recently, 17th of September, we moderated a bit to amber green. That was on the interim results. Very good H1 results from Journeo in line. And I've basically just questioned the valuation, saying maybe a PE of 12 times is about right for this type of business, because it does mainly rely on one-off, quite lumpy contracts. Although as it grows, that's probably less the case. Maybe I was being a bit too cautious there. Fundamentally, we think it's good. It's already 5 back though, so at some point they have to pause for people to take some profit, don't they? But yeah, it seems to be very good.
I don't think I've ever heard you cautious, Paul.
No, I'm pretty. I think I am in the small cap value reports. I'm cautious.
No, you are. Exactly.
I'm not cautious with my own money. Why should I?
Anybody investing? I mean, I wouldn't. You're a sensible investor, put it that way, because anybody investing in small caps has got to be risk tolerant, because your hit rates, generally speaking, are lower than they are for big caps, and therefore you take a lot of whacks, and you can get. You can, rather than losing 10, 15%, you can lose 30, 40, 50% quite quickly. Yes. I mean, that's. Yeah. I don't know if you want to just talk through, because I mean, what seems to be with small caps, you get these wild swings. It goes the share prices, because of the low liquidity, tends to go through ecstasy to total depression, and there's nothing in between. It just vibrates up and down.
Yeah, you're right. Absolutely. I mean, I remember in 2021 thinking this is too good to be true. Everyone's making ridiculous amounts of money. I mean, that was and everything looks expensive. I mean, we were saying almost every day, look, we like the company, but it's not worth a PE of 25 or whatever. But equally, we didn't imagine that 2022 and 2023 would just be so bad. But it's just flow of funds, isn't it? People take the money out to buy Nvidia shares, and the small cap funds were facing redemptions. I mean, I don't know what the latest is on redemptions. you probably know better than I. I mean, have the redemptions stopped now, or are they still ongoing?
They've slowed, and they're slightly negative at the small cap sector. The problem you get with small caps, unfortunately, is liquidity. And if there isn't a tax incentive that encourages people on the street to put money into effectively small cap funds, they will just automatically go into big passive ETFs, which are targeted at large caps, the big indices, or overseas, because it's low cost, and therefore you've got to basically nudge people in the right direction to be able to generate those new startup companies, or to invest in growth capital, i.e. businesses that need to go to the next level and take a bit more risk. If you don't do it, your average Joe public will stuff their money into an ETF. And that's the biggest problem for small caps, is that essentially passives have just done so well. And so when it comes to turning the flow of money into small caps to change that, we've had 36 months, 3 years of outflows, but we won't get any more inflows until essentially, people start seeing, there's good opportunities here. And taking away IHT is just going to be another nail in the coffin for it.
It's certainly not the right time to do it, for sure. But yeah.
Anyway. Okay, one which you've done really well for, you've mentioned a couple of times, Gaming Realms, which is basically a mobile computer sort of casino stroke slots game provider. It's basically licensed out its technology across the world, particularly in the States and the UK, to lots of different providers. What's your sort of the latest investment thesis on this one? Shares have done pretty well.
They have. Well, every time I look at it, I just scratch my head and think, why is it so cheap? It's a growth company priced like a value company. So I last looked at it. Let's have a look. 11th of September's report. I was green on it. This was the interim results. It's just over 100 million market cap. As you say, it's a software company, so it actually provides the streaming, the actual games, and then the online casinos sort of link to it in some way. So it hosts, that's the word I'm looking for. It hosts the software, and the jewel in the crown is this game called Slingo, which seems to be incredibly popular. It's a hybrid of a slot machine and bingo, and customers of these online casinos absolutely love it, and they get a royalty on a sort of per use basis. Gaming Realms does, and it's just got a fabulous track record. I mean, if you look at the growth, it grows revenues and earnings by, I think, well into the teens, maybe even the low 20% compound. It's generating reasonably good cash. The cash flow statement isn't as good as the P&L. That's my only negative point on it. I think they're capitalizing more than they expense on development spend, possibly. But anyway, have a look at Gaming Realms, GMR, if and only if, obviously, you're prepared to invest in gambling-related stocks, which a lot of people don't, because quite a few of us, I think, have got friends who've ruined their lives by becoming addicted to online casinos, and betting on all sorts of things through online platforms. It's doing a lot of damage to society, but that's an assessment each individual investor can make for yourselves. But just purely looking at the numbers, GMR, Gaming Realms, I think it just looks cheap. Yeah.
Have you ever played Slingo down the Mary Shelley at all? Is it on the local fruit machine down there?
I don't know. I remember when I was a teenager, I got hooked on fruit machines. So it was my grandma's fault. She took me to her club for a gin and tonic. And just gave me £1 to play on the fruit machine. This was when I was about 6, and I won the jackpot and took home a huge bag of 10p coins and became completely addicted to fruit machines for a few years. So for that reason, I don't touch them now. So no, I haven't tried the Slingo product.
No, you're right. I had a great lesson. I had a great similar one. I had a great lesson when my father. We used to play tennis at the local tennis club, and my dad was the chairman there, and they had a little fruit machine. Anyway, he gave me 10p, and I stuck it in the fruit machine. This was probably when I was about 5 or 6. I got
Yeah.
3 bells. Fab, brilliant! I got 50p out. I thought I was a flipping, absolute, sort of millionaire. And then I proceeded to put it all. Then I proceeded to put it all back in. Ended all obviously in tears, but it was a lesson I never forgot.
Yeah, yeah.
I just stopped me ever gambling on it again.
I think that was a lesson my grandma intended to teach me, but it backfired rather in my case.
Yeah.
It's like when your parents give you alcohol when you're about 7 or 8. Apparently, my brother vomited everywhere, and I drank it and asked for a second glass.
I had the same. I had a very bad experience with whiskey one day. Okay, right. Let's move on. We've got Rodney Townsend. He's basically asking what will be the next catalyst for Me Group. I know you've talked about this one before. It basically does washing machine servicing and laundrettes, doesn't it? I think is that.
No, Me Group's mainly the photo booths, and then
photo booths. Yeah, and it does these.
Then the self-service laundry is rapidly growing and very, very nicely profitable. Yeah, I must admit, I don't think I've looked at that Me Group recently, but it was on my top 20 for this year, and I think it's up nicely. Yeah, there we are. It's up nicely year to date. It was obviously underpriced. It was just ridiculous value hiding in plain sight at the low point of the chart, which was the main reason I got involved in it. I think more sensibly priced now. Yeah, I looked at it. I haven't looked at it since July, 15th of July. H1 results came out, and I marked it green. Good H1 results, confident in line outlook, good balance sheet and cash flow. And it's self-funding the rollout of the laundry machines, which are very good. I've mystery shopped them. They work well. A lot of them are used by people who are there, staying somewhere temporarily. If you're traveling or as I started asking people who are using the laundry machine why they use them and not a machine at home. And a lot of them were people staying in hotels in London who said, to get my laundry done by the hotel, you'd be looking at hundreds of pounds. So a self-service laundrette over the road is a good service. So it's a nice niche, low cost because they're situated in car parks or petrol station forecourts, so low overheads. I think Me Group's a really nice business. The obvious question mark there is over the long-term aspect of the photo booths business, but that actually seems to, people thought, people will just take their ID photos on an iPhone, but of course the passport authorities and so on don't want those now because they can be doctored. So if anything, it looks like Me Group's photo booths, being properly authenticated and sending the photo direct to an authority could actually be entrenched. So I think it's a very good business, Me Group.
Yeah, no, well, the shares have done terrifically. Got another question, follow-up from Nigel Batty Seams. He's asking, is that your grandma in the background there, Paul?
It's obviously not a very high-resolution image on it, because it's our late dear QE2. She's actually there to block out a table full of junk behind me, which was... yeah. But
okay, let's got just a couple of final ones to finish on. We've got James Halstead, which is a sort of like I think it does floorings for commercial property rather than domestic residential. So I think probably offices or factories. I'm not sure, but anyway, give us your latest thoughts on James Halstead.
Well, I've always thought it looked very expensive, and actually, this is one of the ones because it's a lovely family-controlled business that's quality. I think they've increased the dividends every year since 1974 or something ridiculous like that. So this is one of the ones that's, I think, widely held by the IHT portfolio funds. So that could be why the share price has come down. It's actually now come into reason. So I think it was overpriced for that reason, because every time they got inflows, they just bought more James Halstead shares, and it was valued on P of sort of 25, and it just wasn't worth it, I don't think. Anyway, I looked at the numbers very recently, I think this week actually, and I thought this is now looking really nice. It's a high margin business. They've raised the gross margin strongly, even though the floor covering sector is in a terrible mess at the moment, very low demand. They still managed to increase profits, even though revenue was down, I think, about 9%. Profits were up 8%. So it's a really, really well-managed business, I think. And reading the narrative that came with the numbers, it made me realize, well, doing this reasonably well in, you know, a really, really tough markets where lots of the projects that you mentioned, like new hospitals or schools or factories and things, may not, you know, a lot of them have been put on hold because interest rates rose a lot. Well, we should see that gradually improve. And so you could, when you start to bolt on operational geared upside on Halstead's revenues, which could well happen over the next 2 or 3 years or so. I don't know when. I mean, this so-called recovery seems pretty elusive at the moment, doesn't it? You know, across the board. So I think, although this doesn't look stunningly cheap like some of my other things, I do think Halstead, very, very good quality business. I love the cash flow statement as well. It just throws off loads of cash, very little in fixed assets. So even though they talked about having state-of-the-art equipment and everything, you look at the cash it generates and it dwarfs the capex. It's about 10-15 times the cash flow is what it has to spend on maintenance capex. So it's a really, really nice business, and great to see a British company, isn't it, that can compete globally with high-end niche products.
Yeah, I'm stunned. When I looked at the margins, I mean, I haven't really put the slide rule over before, but it's almost does 20% EBIT margins, which for a floor covering business is just incredible.
It is, isn't it? So they've, whatever they're doing, the products clearly have pricing, a lot of pricing power, great reputation and market. You know, you can just, things like that, you can just see this is obviously a really good quality business. So yeah, but I don't own it myself, and I probably won't buy any. But I just wanted to flag it to the viewers as something that, when you actually look into the numbers, it's better than it looks from the sort of headline statistics, I think.
Yeah. Okay. Well, it's a good positive note. Last one to finish on. We've got Renold, which is an industrial chain and transmission sort of like manufacturer. Does them into sort of like for conveyor belts and all kinds of, you know, mining activities as well as airports, stuff like this. I remember again you mentioned this sort of 2 years ago, and given we've had a bit of a bear market in small caps, this one has doubled in 2 years. So
yeah, it's done really well, hasn't it?
What's the sort of the latest thoughts on this one? Because it seems to be a bit of a real, you know, workhorse, real thoroughbred.
Yeah, it's doing really well. It's doing quite a few bolt-on acquisitions. Now, the only reason I put it on the list to mention today to the viewers is because it seems to have, again, just sold off for no particular reason that we're aware of, you know, in the last few weeks. I did point out that the Employee Benefit Trust has been taken about 9 million quid out of cash out of the company to buy shares that are then going to be given to directors. So I wasn't very happy about that. And it wasn't hidden, it was correctly disclosed, but it doesn't go through the P&L, so hardly anyone had spotted it. And it did flag up that I wrote quite detailed articles on this a few months ago, and some people, some of the readers were quite shocked that all this money had been taken out to buy free shares for the directors. So that did muddy the waters a bit. But the key thing to do is to look on the cash flow statement. That is to flag up to everyone. Always look at the cash flow statement for any employee share trust purchases, because that is cash going out the door to fund free shares for directors. And you need to be aware of that. But anyway, I think it's dropped a lot, Renold has. What, it down to 50p or something?
Yeah.
Worth a fresh look, I think, at that level.
Yeah, well, I mean, you know, you look at the actual chart; it's done fabulous, hasn't it? Okay, great. Okay, well, brilliant. Well, thanks very much for that, Paul. Got one final request. Well, given you've had brilliant performances from your top 20 for the last 2 years, for 2023 and 2024, when are you likely to be publishing your 2025 list?
It'll be, you know, around New Year. So yes, I haven't really even thought about that yet. I think I'm probably going to roll over some of the current year picks into that, you know, on the basis of run your winners. So I would imagine Intercede and Beeks will probably be on it, but that depends on what they report next week. So yeah, basically I'll do another top 20 in late December and early January, and let's hope I can make it a hat trick.
Well, if you do manage to scrape it, if you get any spare time and you do manage to scrape it into sort of mid-December, late, we'll do a big bumper Christmas special on your top 20, because
well, I have to wear a silly hat.
Sorry?
Well, I have to wear a silly hat.
Yeah, you can do it, exactly, yeah. But given you've just knocked the ball out of the park for the last 2 years, obviously that will be hot off the press and people would love looking at it because it'll give them a chance then. They can, in the downtime between Christmas and New Year, where everybody's had too much, they can have a good look through a lot of the stocks. And do.
Yeah, I'm just worried that people might just say, oh, you know, just buy all of them without doing their own research and then blame me when, you know, knowing my, you know, I'll probably have a terrible year in 2025 and everyone will be out with the pitchforks trying to have me lynched. So, you know, this is the risk, isn't it? So people must do their own research. But the basic thing I do with this list, which is why I think it works now, is I just don't touch the speculative stuff. Well, one or two more speculative things, but, you know, you look at people who do these top 10 or top 20 lists, and they're picking all this garbage because they're trying to find 10 baggers, and it hardly ever works. That is my key thing. I just think buying good, steady, reasonably priced GARP shares is a winning strategy, I think, with decent balance sheets and also that have put out a positive recent trading update. You know, those are, I think those are such simple criteria, but they do seem to work. But out of 20, 4 or 5 will probably underperform.
That's a good hit rate. That is a lot. I do a lot worse than that.
Oh, you're too modest, Paul.
What we should do with the top 20 this time, okay? We'll create an ETF and we'll call it Scotty's ETF, and we'll have an index that people can chuck in a few bob.
Oh God, no! That's the stuff of nightmares.
So how we get on. Okay, brilliant. Well, thanks very much, everyone, for your questions. It's been absolute marvelous asking Paul them, and again, thanks for your time there, Paul. Really generous with it. Great insight.
Yeah, I love talking about shares with you, Paul. So yeah, it's all good. Yeah. Thank you.
And hopefully, if we do get a bit of spare time before Christmas, then that would be brilliant to get together, and you know, we can then check out, because it tends to be a bit of downtime anyway. But it goes crazy. Anyway, thanks again.
That's if we can find a slot in December when I'm coherent.
Both of us. I know. Okay, thanks very much then, Paul, and look forward to hopefully chatting in about 2.5 months' time.
Great. Thanks, everyone.